This video expands on our previous discussions of multiples by showing the impact of leverage. You've already seen multiples in an introduction to stock screens and how to adjust numbers for non-recurring items and differences in accounting methods. Let's begin by looking at how company value relates to accounting metrics. In principle, the value of a company equals the value of its discounted cash flows. For equity, this corresponds to the dividends and net stock repurchases, where we can think of a stock issuance as a negative dividend. For the enterprise, this corresponds to the free cash flows, where positive free cash flow either increases cash or reduces debt or equity via distributions to investors. If we add the clean surplus relation to this, we get company value in terms of residual income, where residual income is the profit in excess of the cost of capital. To understand how equity value relates to enterprise value, note that the equity value is simply the enterprise value less the value of net debt. Most of the uncertainty about equity value stems from the value of the operations, the enterprise value. Debt is relatively easy to value because of its priority in receiving cash and its contractually defined payments. Accordingly, when we're evaluating equity value, we typically focus on the component that arises from enterprise value. To more easily understand how valuation multiples reflect assumptions about growth and profitability, we can apply a constant growth assumption to express values in terms of perpetuity formulas. The enterprise-level multiples reflect implicit assumptions about growth and profitability. The equity multiples reflect that plus the effects of leverage. Leverage makes the equity multiples not comparable when you're evaluating expectations about growth and profitability. Because of this, when we want to evaluate investor expectations, it's typically best to focus on the enterprise multiples. To see how leverage affects equity multiples, we can relate the book value of equity to the net operating assets by simply subtracting the debt, which is typically carried at about market value. Similarly, net income is NOPAT less the after-tax interest expense. Under the WACC assumptions, the market value of equity is the enterprise value less the value of debt. We can use this to express equity multiples as a function of the underlying enterprise multiples and leverage. These plots show how leverage affects the equity multiples. The dashed lines are the enterprise multiples that you would have with zero leverage. The market-to-book ratio increases with leverage, especially for high-growth firms. This is true for any companies with enterprise to net operating asset ratios that are greater than 1, or equivalently, with a return on net operating assets in excess of WACC. Price-to-earnings ratios increase with leverage for high-growth firms and decrease with leverage for low-growth firms. We typically want our comparisons of companies to reflect different beliefs about growth and profitability. Because of this, it is typically better to focus on enterprise multiples, because differences in leverage will impact any comparisons of equity multiples. It is also important that you be aware of how leverage impacts equity multiples, because you will often see comparisons of equity multiples in discussions of company value. The enterprise-level NOPAT multiple serves as a great basis for comparing companies because it's sensitive to the growth and profitability assumptions that we are usually the most uncertain about. When conducting your own valuation exercise, you'll have forecasted NOPAT, but when you want to look at comparables, you're going to need analyst estimates. I've never seen an analyst forecast of NOPAT though. Sometimes analysts do forecast EBIT and the effective tax rate from which you can derive NOPAT. Or if you can't get a forecasted tax rate, you may be able to infer the tax rate from forecasts of net income and pre-tax income. That said, it may be difficult to come by forecasts of EBIT. However, many analysts forecast EBITDA. The EBITDA multiple differs from the NOPAT multiple because of the effects of taxes and depreciation. This is not a major problem though, because we're typically using NOPAT multiples to assess implied growth and profitability expectations, and these are mostly reflected in the EBITDA. Before wrapping up the video, let's look at some examples from grocery stores. Casey's General Stores and Northwest have similar leverage, and their differences between their enterprise multiples carry over to their equity multiples. In contrast, we see that Kroger and Northwest have price-to-book ratios of about 3. However, we see that Northwest has a noticeably higher enterprise value to net operating asset ratio. In this case, Kroger has a similar price-to-book ratio because of its high leverage. For another example, Sprouts has the highest enterprise to NOA multiple in the group, but it has the lowest price-to-book multiple. The difference is because Sprouts has very low leverage. You can also see that the difference between Kroger's and Sprouts' price-to-earnings ratios is much larger than the difference between their EBITDA multiples. Much of the greater difference stems from Kroger's leverage. For another example, if you were to look at the equity multiples for South Africa's Pick n Pay, you might think that the multiples imply that investors are overly optimistic compared to other grocery retailers. However, the enterprise multiples indicate that investor expectations about future growth and profits are well within the range of the other retailers. Pick n Pay's leverage drives up its equity multiples. This completes the video on how leverage affects multiples. Make sure to take this into account when using multiples to compare companies, such as in stock screens.